Hello and welcome. He's a tough man to pin down, but we've been lucky enough to speak to Sir Martin Sorrell, Chairman of WPP Group, the world's largest advertising and communications conglomerate with a substantial presence in India as well. You know their brands JWT and others. We're going to be asking Sir Martin about the Indo-British corridor and some of the economic issues that are plaguing business, not just in India but the rest of the world. Sir Martin, thank you very much for speaking with us today. So first question, how are you seeing the economic environment from your standpoint as a global company head, and also maybe we can talk a little bit about the Indo-UK corridor?
Well, overall I think things are, let's put aside Indo-British relationships for a minute and just talk about what's happening economically. I mean, it's tough sledding. I mean, it's a bit of a slog. Western Europe obviously is under pressure. UK for us has actually been quite good. When we see what Western continental Europe has been reasonable, it's been flat, whereas for others it's been down. But certainly France, Italy and Spain is tough for most people. Germany has been, like the UK, sort of bookends for Western Europe, and has been actually a little bit better. When we look at Eastern Europe, I'm bullish on Eastern Europe, on Russia. Poland's a bit soft, but Germany, Poland and Russia, the world may be moving eastwards, and so's Europe. The US for us has been it's been okay, but the sequester has slowed things slightly, and I think we should have done a bit better in the US. Latin America is extremely strong, the strongest region, and Asia generally is strong, along with Latin America. So the whole of Asia, whether you're between Japan and Australia. Australia is two economies, Western Australia, which is stronger because of commodities and resources, and Eastern, which is weaker. But all the stuff in between, if I can put it like that, which includes markets like China and India, despite the slowdown, is pretty good. Having said that, that's geographically. Functionally, obviously our media business, our media planning and buying business, what we call media investment management, is strong. Our digital business is strong. The softer parts of our business are the discretionary custom businesses like custom research, not syndicated research, custom research, areas such as public relations and public affairs and branding and identity, again, which are project businesses. Healthcare has been quite strong. So overall, for this year, we're running at the end of the fifth month, May, at about between 2 and 3% like-for-like growth. Acquisitions at another 2 or 3%. Currency, there's a tailwind this year rather than a headwind as there was last year. So our revenues in the first 4 months were up about almost 7%, as we disclosed in our AGM earlier this week, and that's carried on into May. So I expect for the year it to be slightly better than that, because the sequester has had a dragging effect, as I said, on the US. So we should see like-for-like growth of around 3+%. We're budgeting 3, right, and we'll do better than that, hopefully, in the revised forecast. Right. So all in all, not on fire by any means, but not unmanageable. But clients are very focused on cost, and sadly not focused enough, in my view, on the top line. In the fast growth markets like India, they're looking to increase their capacity in the BRICS and the next 11. In the slow growth markets like Western Europe and US, particularly Western Europe, they're squeezing capacity.
Right, you did mention clients. Are you seeing any commonality in their behavior at this point of time and the way they are approaching fresh investments, maybe in areas like manufacturing or others?
Well, the commonality is in the fast growth markets, geographical markets and functional markets, like in our case digital, there's expansion and growth. I mean, in digital, even in the mature markets of Western Europe and the US. So in the fast growth markets, they're willing, the risk reward ratio is more aligned. In the slow growth markets, Western Europe in particular, they're not willing to take any risks, and they're squeezing capacity, reducing capacity, obviously reducing employment, and hence the high levels of unemployment generally in the Eurozone at 11-12%, and double that in terms of youth unemployment, 25%. So, and boards by and large are risk averse. Post Lehmnan, September 2008, nobody wants to take risks. I see it with our own board, I think less so than most, but an unwillingness really to see great disturbances. Hence the lack of activity in M&A, and I don't think it'll come back. Average life of a CEO worldwide is about 3 years. Average life of a CEO in the US about 4.5 years. Average life of a CMO, Chief Marketing Officer in America, is about 2.5 years. You know, why take the risk? Particularly listed companies looking for performance, even private equity companies who have to perform to very high rates, internal rates of return. People are unwilling to take the risk. So there's risk aversion, hence balance sheets are very liquid. Procurement and finance rule the roost, particularly post-Lehman. I think Lehman had a bigger effect on corporate behavior than it did on consumer behavior. People tend to think it had a bigger effect on consumers. I disagree. And corporates, you know, if you look at corporate profits as a proportion of GMP, they're the highest they've ever been. Margins are high, stock prices are high, driven by QE, it's true, rather than loose monetary policy, rather than fundamentals. But, you know, somebody said to me today in Paris, there's $20 trillion in treasuries and government securities earning 1%. There's nowhere for them to go other than to equities. So there's all this liquidity. Consumers' balance sheets have been improved post-Lehman. Corporate balance sheets are very strong post-Lehman. The only balance sheets that are not strong are government balance sheets, and those are where we've got to see the pressure. So the commonality in behaviour is expand in the fast growth markets and contract or hold your position in the slow growth.
Right. In this context, how do you see investments coming into India? I know you've been quoted saying that WPP is holding at 10% growth in India, which is pretty strong. And are you seeing any specific trends or shifts in the way investments are coming in or the way business is growing?
Well, in India, just like the other BRICS, just like Brazil, Russia and China and others in the next 11, or if we exclude Iran, the next 10. So countries like Pakistan, like Bangladesh, like Indonesia, like Nigeria, like Colombia, like Mexico, like Turkey, these markets which are the new growth markets, or the latest one would be Myanmar, where I was a few days ago, where we've started 6 operations. We've got small amounts of revenue there this year, but we'll double up next year. And it's 60 million people. So it's not the scale of India by any means. It's not the 1.2 billion people in India. But it's certainly unusual for a market of this size to become available as it has become recently.
Right. And I was going to ask a region question as well. So you've recently restarted operations in Myanmar as well.
We acquired an operation in what was then called Burma. We had to disgorge that because of the sanctions. Now that the sanctions have effectively been lifted, we've gone in since May of last year. We already have about 150 people there. Now in India, just to explain, we have a very big operation in India, $500 million of revenue out of about 21 billion worldwide. We have about 12,000 people. It spans advertising. You're in one of our agencies, JWT, with Ogilvy, Y&R Gray. It spans media investment management, Group M, with Mindshare, with MEC, with Mediacom, with Maxus. We have a joint venture with Sam Balsara there with Mediacom. In television audience measurement there with our Kantar operations, our public relations and public affairs business, Hill & Knowlton, Bursa Marsteller, Ogilvy PR, Conan Wolfe. And last but not least, branding and identity, Landor, Fitch, Brand Union, healthcare operations, and of course all our digital operations, including companies like Quasar, which are extremely strong there. So Wonderman, Ogilvy One, VML, AKQA will start operations there generally. So it's a very broadly based operation, has a very big market share there, very strong. We have 5 of the top 10 agencies in most segments, advertising and media, so a very strong position. And we're very proud of our position, very proud of our people. Last year, including our associates, they grew by about 10%. They will grow top line. They will grow their top line again by about 10%. And this contradicts what's happening to GNP, because GNP has slowed, obviously in advance of the election. There's some uncertainty and some concerns about what the results may be, and I think that has slowed things down. But our business really is driven, the heart of our client base is driven by what happens in the fast-moving consumer goods industries and what I call the capital consumer goods industries, like cars and autos and trucks. And those those industries depend for their growth on the growth of the middle class, on the lower middle class. And of course, India, just like China and other parts of the world, have witnessed a massive increase in the number of people that you can count in the middle class and in the lower middle class. And I think that's a tremendous advantage that we have. So we're not really representative of the capital-intensive industries. We're more representative of the consumer goods, the mass consumer goods industries. So, and what we see in India is continued expansion, buoyed and driven by this expanding middle class and lower middle class. And as Piyush Pandey, who's quite a very famous Indian creative director, the chairman of Ogilvy in India, said to me, in Rajasthan, which he hails from, he noticed people are still swapping two-wheelers for four-wheelers, and the general level of wealth, although there is considerable inequality, and that's an issue of rising concern, what we see in India is continued expansion and growth, which is unlike what we see in Western Europe, for example.
Right, so this is a question that must be asked at every such occasion, and it's a China question. So how are you looking at the two countries today in terms of growth and growth opportunities?
Well, first of all, it's not China or India, it's both. It's
yes.
Just like if you said to me, is Brazil better than India or China? The answer, I would say, you do all three, or in the case of the BRICS, you do the BRICS and Next 11. Those markets are 1/3 of our business, just like one third is digital, and we want them, both those segments, to be 35 to 40% of our business. So it's continued growth in all those markets. The Chinese have an incredible, well, our business is 1.5 billion there, so it's 3 times the size. We have 15,000 people there as opposed to the 12,000 in India. So we have a very big operation. Our market share in China is only 15%, whereas it's considerably bigger in India. So India is a smaller market, is relatively under-branded, which is a big opportunity, obviously, for our clients and us and for the media, and will grow, I'm sure, rapidly. Both countries will grow rapidly. But the lesson of China is infrastructure. And, there's a lot of criticism of the Chinese for oversupplying infrastructure, for empty, roads that go nowhere, buildings that are empty. I do not believe that to be the position. I've just spent 2 weeks in China seeing 17 major Chinese companies, because our business is split 60% foreign multinationals in China, 40% local. And the impression, the overriding impression, I wrote an article for The Telegraph on this. Not that many people read The Telegraph, but I wrote it for the Telegraph last weekend. The first thing is they're highly innovative. The second thing is that they're increasingly understanding marketing. And the third thing is that they are increasingly looking for expansion outside the 1.3 billion in their market. I mean, they're blessed with, just like the Indian countries are best, or the states and territories of 27 or whatever it is, states of India are blessed with a population of 1.1, 1.2 billion people. China has 1.3, so you have this massive market in your backyard. But even then, Chinese companies are going global. So I think, India positions itself as, the fastest growing democracy, and I agree with that, and I have great sympathy, and I've worked with a number of Indian leaders on building India's reputation at Davos and elsewhere, and I'm very proud of our operations there, and proud of the business that we've built in India, and of the people of the highest quality. And I often say, if we had people like Indian people everywhere in the world, I could retire. So and go away, which some people might like to see me do. But anyway, but the point is that the Chinese have a planned economy. They come in for criticism for all sorts of reasons, because it is a much more centrally planned system, less, we have to acknowledge, less democratic, but it gets there faster. So I think the lesson, and I think the lesson not just for India but for other countries, even I would say for Western economies, or the Singaporean lesson, if I can put it on a much smaller scale, with only 5 million people, just over 5 million people, rather than 1.3 million. The lesson is, planning, integrated planning works. And I think the infrastructure issue is the issue that I think India has to deal with, and it's making more and more attempts to deal with it, but there's a long way to go.
Right. So let me bring you back to the Indo-UK corridor and the India-Britain business relationship. What are the kind of areas that you think companies who are coming into India or want to come into India should be looking at, or what advice would you give them at this point of time?
Well, I think if one's really, I was just in preparation for this looking at the top 10 exporters to India. And the UK isn't in it. We're not in the top 10 according to the statistics I have here. 212 to 13 share from April to September. If I look at the top 10 importers, the UK is number 8. US is top, and China is the biggest exporter to India, which I suppose is not surprising. The bilateral trade between the UK and India, and the relationship between the UK and India, is not strong enough. The Prime Minister was there in India playing cricket and eating curry, a Kerala fish curry, I read, in February, and was underlining the importance of developing bilateral trade both ways. And, when you think about the history, maybe the history is a liability. I think it's an asset. The language and the relationship is a very strong one. But I was very struck, and this may not be something that everybody appreciates, but I was very struck. I was talking to, let me call him an Indian oligarch, about 2 years ago, 18 months ago. And he said to me that his kids were going to an American university. And I said, well, why aren't they going to a British university? And he said, well, when I look at my kids, they have greater affinity to the US, let me put it like, McDonald's and Coca-Cola, than they do to the UK, whatever, Beefeaters and the Queen, or whatever we want to put it in the same context. And that I found very troubling. You take our education system, and clearly there have been visa issues, and not just for students, but for business too. And that's an area which, should be improved. There's the whole immigration issue here in the UK. The UKIP Independence Party, UK Independence Party have got, 40% of 24% of the vote. God forbid it should be 40. 24% of the vote in polls and in local elections. And obviously they're a force, and politicians are in business to be elected or re-elected, and therefore they're very conscious of that. And in tough times, protectionism becomes, rampant, and it's a dangerous disease that spreads, or virus that spreads. So we have that. But going back to that conversation, I found that deeply disturbing, that the ties between India and Britain were weakening rather than strengthening. And it's just a random conversation in a way, but it is indicative. If I look, for example, at some of the big academic grants, like the Mahindra grant or the Tata grant, they don't go to British universities. They go to American universities, Harvard or whatever it happens to be. And, the British education is one of our strongest assets at the primary and secondary level. It can always be improved, and at the university level. And, this is something that should bind us together. It shouldn't keep us apart. So there's that area. There's openness for example, in the financial services and legal services industry in India. I have to say that in the 28 years I've been attempting to run WPP, and in the 9 years I had at Sarches before, when we also had operations in India, I've had few, if any, problems. There have been one or two, but few, if any, problems. And the government has been positive and welcoming. Clients, both obviously foreign multinationals seeing a growth market, have seen it one of great potential, and they've been encouraging, and we built our business. Local companies, and you have these, wonderful companies like Hindustan Lever, the Unilever's operations in India, which over the years have grown so successfully and are very powerful operations in the context. You know, the Ambani brothers with the two Reliance groups, Mahindra, I've mentioned, Tata. I mean, all these companies, Bharti,
right.
Bharti Airtel, the pharmaceutical companies. These are stunning success stories that are not just Indian success stories, but global stories. You know, taking over Jaguar Land Rover, taking over Chorus, Tata Tea. I mean, all these things are wonderful stories, and they're wonderful companies, and we're very proud of what we've done. But, you know, frankly, when I look at those statistics on import and exports, it's very disappointing, really, the extent of it. And by the way, this is a general criticism we could make of the UK, that our patterns of trade are still EU dominated and are still old market dominated and US dominated, and not enough Asia, Latin America, Africa, the Middle East, and Central and Eastern Europe. It has to be more. That's where the great, you know, a third of our company depends for it. You know, a third of our company is located in those countries. Myanmar opens up, we're all over it like a rash, because, you know, we've got to make sure that we have first mover advantage and move ahead. So I'm a tremendous believer in this. Just as the same in digital, when there are functional things that move faster, you've got to get there, and you've got to get there quickly. And I'm a tremendous believer in it. And I think we've had a phenomenal, you know, we've had a lot of luck, because we acquired JWT in '87, always has had a wonderful operation in India. In '89, we acquired Ogilvy, wonderful operation in India. David Ogilvy, almost to his dying day, was chairman of Ogilvy India. But India hated to fly in planes, took a boat to India for the annual general meetings or whatever. His books were translated into all forms of Indian languages. And, you know, he was deeply loved, I think, and revered in India for his writings and his pronunciation. And, you know, Indians are really attuned to the advertising industry. It's a very strong industry in India. They do well in Cannes. We have Cannes next week, the advertising festival. I'm sure they'll do well again. So all in all, extremely positive about India, but really not, I don't think UK has got enough traction in India, and that we have to have more. And, you know, It's disappointing. It's disappointing when the French sell jets to India and the British don't.
Right. So, Martin, thank you very much for speaking with us.